Welcome to the Explainer. You know, last week I ran Banc of California, ticker symbol BANC, through 5 distinct valuation models and the legendary investing checklists of Warren Buffett and Peter Lynch. And honestly, what I found absolutely shocked me. Right now, we're looking at a regional bank that is throwing off the most violently mixed signals in the entire market. I mean, we're talking about a situation where its true intrinsic value could be drastically different than its current share price. So stop what you're doing, seriously. If you own bank, or if you're even thinking of touching regional bank stocks right now, you need to see this 5-model valuation breakdown. Because here's the massive red flag. A major insider, the private equity giant Warburg Pincus, just dumped nearly $645 million of the stock. Yeah, that's 32.2 million shares unloaded right onto the open market. Usually when a huge institutional backer pulls the ripcord and runs for the exits with a $500 million parachute, well, retail investors panic. It hits right at our biggest fear. What do they know that we don't? But wait, before you go and hit that sell button out of pure panic, look at this. Ask yourself a bold question. Why on earth would the president of the bank, Hamid Hussein, step in and aggressively buy almost $300,000 worth of shares with his own hard-earned money at the exact same time? It's crazy. We've got massive institutional capital fleeing on one side and executive leadership literally doubling down on the other. It's this massive contradiction, like a giant puzzle that absolutely demands a deeper look. This sets up the ultimate retail investor mystery. By the end of this explainer, I promise you're going to have a clear, actionable framework to know for sure. We're going to figure out if BANC is a generational Warren Buffett-style buy that's quietly being scooped up by insiders, or if it's a catastrophic value trap just disguised by a really cheap share price. So let's dive right into the hard numbers.
Section 1. Smashing Q1 2026 earnings. The bull case. Let's see what the data actually says.
Right out of the gate, looking at their Q1 2026 earnings release, Banc of California cleanly beat Wall Street's expectations, hitting both the top and bottom lines. They posted 39 cents per share in diluted earnings. That's a massive 50% year-over-year increase, just edging out the 38-cent estimate. And on the revenue side, they brought in nearly $287 million, beating forecasts by over $2 million. Now, this isn't just some clever accounting trick, right? It reflects actual, tangible growth in their core, day-to-day business. Now, we definitely have to acknowledge the number one fear everyone has with regional banks these days: liquidity. Ever since the banking panic a few years back, we all just want to know, is the vault actually full? Well, check this out. Banc of California boasts a staggering $15.1 billion in available borrowing capacity and on-balance sheet liquidity. To really put that number into perspective, that is 2.1 times greater than their uninsured and uncollateralized deposits. That is what you call a true fortress balance sheet. And their net interest margin, it's actively expanding. It grew to 3.24% in Q1 of 2026. What we're seeing here is a bank that's just successfully remixing its balance sheet. Even with all the wild rate fluctuations out there, they're generating real, sustainable operating leverage. The yield on their assets is literally outpacing the cost of keeping their deposits. Actually, their average cost of deposits dropped by 14 basis points. That right there, that is the humming engine of a highly profitable bank. Section 2. Dividends and massive buybacks. How are they treating shareholders? Get a load of this. Management recently doubled down, literally doubled their stock buyback program to a jaw-dropping $300 million. Now, as a quick reminder, when a company buys back its own stock, it shrinks the number of available shares. That mathematically drives up the intrinsic value of every single remaining share you own. For our valuation models, that is a massive, glowing green flag. And they aren't just talking about it either. They've already repurchased over 15.3 million shares. That means they've rapidly eaten up over 9% of their total outstanding float, snagging them at an average price of around $14.16. Basically, management looked at their own stock price, decided the market had it severely undervalued, and took really aggressive action to pump up that intrinsic value for long-term holders. Oh, and on top of those massive buybacks, they're paying out a very healthy 2.5% dividend yield. And they aren't just coasting and maintaining it, no, they just grew it. Their quarterly payout jumped by a huge 20%, going from 10 cents to 12 cents per share. So let that sink in. You are literally getting paid cold, hard cash to hold on to a stock that the company itself is actively making more scarce.
Section 3. Wall Street's bullish consensus. Let's see what the pros think.
Turns out it's virtually unanimous. Out of 11 major Wall Street analysts tracked by S&P Global, 10 of them rate Banc of California as a buy or a strong buy. Only one single analyst rates it a hold, and listen to this. This is the crazy part. Not a single one says to sell. Zero. Heavy hitters like Piper Sandler, JP Morgan, and Barclays, they are all maintaining deeply bullish ratings on this stock. And that optimism builds directly into their price targets. The median Wall Street target currently sits right at $22.68. From current trading levels, we're talking about a fantastic 18% upside. They're looking at a well-capitalized bank, really strong margins, those aggressive shareholder returns we just talked about, and they are pricing it all accordingly. Section 4. The looming CRE threat, the bear case. Because it can't all be sunshine and rainbows, right? So here is the big question. If the fundamentals are really that perfect, why did we see that $644 million insider dump? Well, the giant elephant in the room is spelled out right here in a recent report from Fitch Ratings. While the bank has absolutely improved its funding profile, it still maintains a staggering concentration in commercial real estate, or CRE. Get this. Having 286% of your risk-based capital tied up in commercial real estate is the exact metric that keeps regional bank investors staring at the ceiling at 3 a.m. In our post-pandemic world, with shifting work-from-home habits and much higher interest rates, commercial real estate, especially certain office sectors, is widely considered the next major ticking time bomb for the banking system. If those loans start defaulting en masse, a 286% concentration could severely gut the bank's capital reserves. But when you actually lift the hood and look under that scary 286% figure, the risk gets incredibly nuanced. Their CRE portfolio is actually highly diverse. The most toxic asset class right now, which is large commercial office space, well, that makes up only 7.6% of their CRE loans. The vast majority is spread across industrial, retail, hotels, and multifamily units. Plus, their overall loan-to-value ratio is sitting at a very conservative 59%. So while that total concentration is undeniably a massive fundamental risk on paper, the underlying assets themselves are highly structured and a lot less scary. Section 5. Value play or trap. The final verdict. Ultimately, it all comes down to weighing these two massive opposing forces against our valuation frameworks. On one side, you have the bull case. $15.1 billion in pristine liquidity, expanding net interest margins, an 18% projected upside from Wall Street, and an incredibly aggressive $300 million buyback program that's being personally championed by the bank's own president. But then, on the exact opposite side, the bear case, a $644 million institutional insider fleeing the stock, and an undeniably heavy 286% commercial real estate burden hovering menacingly over their capital ratio. So, based on this hard fundamental breakdown, I'm going to leave you with this final thought. When you factor in the massive share repurchases that are shrinking the float, and you balance it against the diverse reality of their commercial loan book, does this fit Peter Lynch's criteria for a misunderstood, undervalued gem? Or is it just a classic value trap waiting to spring? Ask yourself, is chasing that 18% upside truly worth the looming structural risk of the commercial real estate market? That right there is the ultimate test of your investing thesis. Thanks for joining me on this explainer. And as always, keep your eyes on the data.